Introducing Accounting in Business. Chapter 1. Introducing Accounting in Business. As with most texts, the first chapter will be devoted to an introduction to terms and techniques we will be using in the remaining chapters. For some, this may be your first business course and the terms will be new. We will be discussing many of the key concepts introduced here in the remaining chapters of the text. Importance of accounting is a system that accounting identifies records, information that is relevant, communicates. Accounting is an information and measurement system that identifies records and communicates information that is relevant, reliable, and comparable about an organization's business activities. The goal of the accounting process is to provide helpful information to users of financial information. Quality information may help users reach more informed decisions. Reliable about an organization's business activities. Comparable 1 to 2. Accounting activities. Identifying business activities. Recording business activities. Communicating business activities. Not all transactions entered into by a business entity are capable of being recorded. Our first task as accountants is to identify those transactions that may be recorded in the accounting system. To record business transactions, we must follow the rules of double-entry bookkeeping. We will spend a significant amount of time early in the course discussing in detail the rules of the accounting process. Communicating business activities requires preparing accounting reports such as financial statements. It also requires analyzing and interpreting such reports. 1 to 3. Users of accounting information. External users. Lenders. Shareholders. Governments. Consumer groups. External auditors. Customers. Internal users. Managers. Officers. Internal auditors. Sales staff. Budget officers. Controllers. We must follow standard formatting when reporting information to users outside the organization. External users include stockholders of the company, lenders, various governmental agencies, and others. Accountants also prepare reports for internal users. Managers of the business need information to help direct and control operations of a business. The sales/marketing department needs information about customers and products. Officers of the company need information to develop strategic plans. 1 to 4. Users of accounting information. External users. Financial accounting provides external users with financial statements, shareholders, lenders, etc. Internal users. Financial accounting provides external users with financial statements. Managerial accounting provides information needs for internal decision makers. In this book, we will spend most of our time developing financial accounting information for external users. Some of the material we cover will prove useful to managers and other internal decision makers. Managerial accounting provides information needs for internal decision makers, officers, managers, etc. 1 to 5. Ethics, a key concept. Ethics beliefs that distinguish right from wrong. Accepted standards of good and bad behavior. Ethical behavior is the cornerstone of the accounting profession. Recently, we have seen many corporate scandals involving individuals who acted in an unethical, and oftentimes illegal, way. Ethics is the belief system that permits us to distinguish right from wrong. It is something that we develop over our lifetimes and serves to help us identify good and bad behavior. Congress passed the Sarbanes-Oxley Act, also known as SOX, to help curb financial abuses at companies that issue their stock to the public. The desired results include more transparency, accountability, and truthfulness in reporting transactions. 1 to 6. Guidelines for ethical decisions. Make ethical decision. Identify ethical concerns. Analyze options. You have faced ethical situations in school and will face similar situations at work. We should be capable of identifying ethical concerns and analyzing our options, that is, what is the right and wrong thing to do. Making an ethical decision means we choose the best option available under the circumstances. Use personal ethics to recognize an ethical concern. Consider all good and bad consequences. Choose best option after weighing all consequences. 1 to 7. Generally accepted accounting principles. Financial accounting practice is governed by concepts and rules known as Generally Accepted Accounting Principles, GAAP. Relevant information affects the decision of its users. Financial accounting is governed by a set of rules we call Generally Accepted Accounting Principles, or GAAP for short. Generally accepted accounting principles identify three major characteristics of information. First, the information must be relevant. Relevant information impacts the decision of the informed user for financial information. Second, the information must be reliable. Finally, the information must be comparable. Comparability helps us compare financial information from one period with that of the next period. Reliable information is trusted by users. Comparable information used in comparisons across years and companies. 1 to 8. Setting accounting principles. In the United States, the Securities and Exchange Commission, a government agency, has the legal authority to establish reporting requirements and set GAAP for companies that issue stock to the public. The Financial Accounting Standards Board is the private group that sets both broad and specific principles. In the public sector, the Securities and Exchange Commission has the authority to establish accounting principles for companies reporting to the agency. Currently, the Securities and Exchange Commission has accepted all pronouncements of the FASB for use by reporting companies. The Financial Accounting Standards Board is recognized as the group in the private sector that makes specific accounting principles. If an accountant departs from the principles established by the FASB, proper disclosure of the departure must be made. The IASB International Accounting Standards Board issues international standards that identify preferred accounting practices in other countries. More than 100 countries now require or permit companies to prepare financial reports following IFRS standards. The International Accounting Standards Board, IASB, issues international standards that identify preferred accounting practices. In other countries, more than 100 countries now require or permit companies to prepare financial reports following IFRS standards. 1 to 9. Sarbanes-Oxley Act. C4. In response to a number of publicized accounting scandals, Enron, WorldCom, Tyco, Imclone, Congress passed the Sarbanes-Oxley Act, also called SOX, in 2002 to help curb financial abuses at companies that issue their stock to the public. The act requires that public companies apply both accounting oversight and stringent internal controls. The desired results include more transparency, accountability, and truthfulness in reporting transactions. In response to a number of publicized accounting scandals, Enron, WorldCom, Tyco, Imclone, Congress passed the Sarbanes-Oxley Act, also called SOX, in 2002 to help curb financial abuses at companies that issue their stock to the public. The act requires that public companies apply both accounting oversight and stringent internal controls. The desired results include more transparency, accountability, and truthfulness in reporting transactions. 1 to 10. Principles and assumptions of accounting. Measurement principle, also called cost principle, means that accounting information is based on actual cost. Going concern assumption means that accounting information reflects a presumption the business will continue operating. Revenue recognition principle provides guidance on when a company must recognize revenue. Monetary unit assumption means we can express transactions in money. Matching principle, expense recognition, prescribes that a company must record its expenses incurred to generate the revenue. Time period assumption presumes that the life of a company can be divided into time periods, such as months and years. Here are some key principles and assumptions of accounting. Accounting principles. The measurement principle, also called the cost principle, tells us that accounting information is based upon actual costs incurred. We refer to this cost as historical cost. The revenue recognition principle provides guidance on when a company must recognize revenue. The matching principle, expense recognition, prescribes that a company must record its expenses incurred to generate the revenues. The principle of full disclosure requires a company to report the details behind financial statements that would impact users' decisions. Accounting assumptions. The going concern principle states that, in the absence of information to the contrary, the business entity is assumed to continue operations into the foreseeable future. The monetary unit principle means we can express transactions in monetary terms. The time period assumption presumes that the life of a company can be divided into time periods, such as months and years. A business entity means that a business is accounted for separately from its owner or other business entities. Full disclosure principle requires a company to report the details behind financial statements that would impact users' decisions. Business entity assumption means that a business is accounted for separately from its owner or other business entities. 1 to 11. Business entity forms sole proprietorship partnership corporation C4. There are three general forms of business operations. A sole proprietorship is a business owned by just one individual. A partnership is owned by two or more individuals. Some partnerships have several thousand partners. A corporation is owned by individuals who normally are not active in the day-to-day operations of that business. For example, you may become an owner of IBM by purchasing shares of stock on the New York Stock Exchange. While you are a part owner, you do not necessarily work for IBM nor are active in the operations of the company. 1 to 12. Equals plus accounting equation equity assets liabilities shareholders. The basic accounting equation states that assets are equal to liabilities plus equity of a company. The equation makes sense because in a general way it states that assets must be equal to the claims against those assets. If you have an asset, we can have two broad categories of claims against that asset. First, we may have claims by creditors for liabilities. Finally, after all creditor claims are satisfied, the residual loaners and stockholders have a claim on those assets. Liabilities plus equity. Assets. 1 to 13. Resources owned or controlled by a company. Assets. A1. Cash. Accounts receivable. Notes receivable. Resources owned or controlled by a company. Vehicles. Land. Assets may be viewed as resources owned or controlled by a company. They include such items as cash, accounts receivable, amounts owed to the company by customers, land, building and equipment, and supplies. Buildings. Store supplies. Equipment. 1 to 14. Creditors' claims on assets. Liabilities. A1. Accounts payable. Notes payable. Creditors' claims on assets. Liabilities represent the claims of creditors on the entity's assets. Liabilities include accounts payable, amounts we owe to creditors for assets purchased on account, notes payable, taxes payable, and wages payable, amounts we owe to our employees at the end of the accounting period. Wages payable. Taxes payable. 1 to 15. Shareholders' equity owners' claim on assets retained earnings. Contributed capital. Retained earnings. Owners' claim on assets. The equities of an entity include investments by owners, contributed capital, and payments to those owners, dividends. Retained earnings represents all of the accumulated earnings of a corporation that have not been distributed to shareholders. Dividends. 1 to 16. Expanded accounting equation. Liabilities. Equity. Assets. Equals. Plus. Liabilities. Assets. Equals. Plus. Shareholders' equity. Revenues. Expenses. Contributed capital. Dividends. Underscore. Plus. Here is a breakdown of the equity section of the accounting equation to show the mathematical signs we will be using to keep track of investments by owners, common stock, payments to owners, dividends, revenues and expenses. Notice that revenues increase equity and expenses reduce equity. Retained earnings. 1 to 17. Financial statements. P2. Let's prepare the financial statements reflecting the transactions we have recorded. Income statement, revenues, expenses. Statement of retained earnings. BEG. RE plus NE or NL, dividends equals end. RE. Balance sheet, A equals L plus SHE. Statement of cash flows, a great challenge. There are 4 fundamental financial statements used in accounting. The income statement shows our revenues and expenses. The statement of owner's equity shows the change in the owner's equity during the current period. The balance sheet is a listing of all asset, liability, and equity account balances. The statement of cash flows shows where the company obtained its cash and how it spent its cash. The first financial statement that we will prepare is the income statement. Let's get started. 1 to 18. Net income is the difference between revenues and expenses. Income statement. Net income is the difference between revenues and expenses. Net income is defined as the difference between revenues and expenses. If expenses exceed revenues, we have a net loss rather than net income. Financial statements have a 3-line title with the company name, the name of the statement, and the period covered by the report. In our case, we had total revenues of $3,000 and total expenses of $800, so net income for the month ended December 31, 2011, was $2,200. After completing the income statement, we may prepare the statement of retained earnings. The income statement describes a company's revenues and expenses along with the resulting net income or loss over a period of time due to earnings activities. 1 to 19. Statement of retained earnings. P2. The net income of $2,200 increases retained earnings by $2,200. In the statement of retained earnings, we start with the balance at the beginning of the period, add net income earned during the period, and deduct any dividends paid, resulting in the ending balance in retained earnings. The company was started this month, so the beginning balance in retained earnings was 0. During December, net income of $2,200 was earned. In addition, $500 in dividends was paid, so the ending balance in retained earnings is $1,700. After we complete this statement, we can prepare the balance sheet. 1 to 20. Balance sheet. P2. The balance sheet describes a company's financial position at a point in time. The balance sheet is an inventory of assets, liabilities and equity at the end of the month. Our total assets are equal to $26,900. This includes cash of $9,700, supplies of $1,200, and equipment of $16,000. Liabilities include accounts payable of $1,200 and notes payable of $4,000. The common stock account has a balance of $20,000 and we just calculated the ending balance in retained earnings of $1,700. You can see that the books are in balance because total assets are equal to total liabilities plus equity. Creditors have claims against our assets of $5,200. The owner has claims to assets of $21,700. 1 to 21. Statement of cash flows. P2. We will cover the statement of cash flows in detail in a later chapter. Notice that the statement is divided into three major sections. 1. Cash flows from operating activities. 2. Cash flows from investing activities. And 3. Cash flows from financing activities. The statement reconciles to the ending cash balance on the balance sheet of $9,700. 1 to 22.